Hey everybody, Boris. Welcome to the Calm Dollar edition of the July 18, July 22nd technicals. A really interesting story sort of in all the Calm Dollars this week, in the sense that a lot of stuff that we thought was actually going to happen last week went the other way. There was a few wrinkles in the ointment because a lot of the data went quite the opposite of what we expected, and there was some other news that came out that I think is worthwhile for us to understand. First of all, Aussie. Aussie was the clear winner by far across the board this week. And the reason is because the Chinese data was actually significantly better than everybody thought. It beat on all fronts: GDP, retail sales, industrial production. That helped boost Aussie. The Aussie story still remains, and this is interesting because I think, of course, for all of you who are in Australia and are listening to this, the Aussie story remains whether the RBA keeps the interest rate alive. And as long as they don't cut, and it doesn't appear right now that the RBA is going to step up to the plate and cut, because there's just not enough problems with the Australian economy. Australian employment, for example, had huge jump in full-time employment, which was really the only metric that I think mattered. And that obviously put a bit into the Aussie as well. But it was really sort of this combination of relatively decent domestic demand with pickup in Chinese demand. Although, of course, Chinese demand, everybody noticed, was really driven very much by credit spending. But whatever, as long as it may not be sustainable in the long run, but as long as it's sustainable for the next couple of months or so, it really keeps the Aussie in an up path and keeps it certainly on target towards the 77 level, which we'll discuss in just a minute. Now, dollar CAD was actually the big surprise, because we thought dollar CAD was going to be the weakling in the whole pairing this week, and it really wasn't. The reason why is because I think the Bank of Canada came out and just did not admit that the problems within the Canadian economy were significant enough for them to further ease in any way, shape, or form. They really did not suggest even a modicum of easing going forward, meaning that they were going to consider cutting rates if they had to. And oil kind of rebounded. I mean, oil sort of stayed around that 45 to 50 level. It bounced back up and down. And of course, dollar CAD is such an oil trade that it's very, very hard to handicap it on a day-to-day basis. For the time being, it still is the thing about dollar CAD is, if you look at it on a longer-term basis, I still think it's a buy, meaning that the Canadian dollar is a sell, mainly because the oil numbers, until and unless the oil numbers go above the $50 per barrel consistently. In other words, WTI trades above $50 a barrel on a consistent basis. You still have to believe that the slow and downward drift in oil to the downside is going to have an impact on dollar CAD and pushes back up. But certainly this week was a big shocker to those that wanted to get long the pair, because it decimated everybody. It's mainly on the oil flows, and this is why it's very dangerous to trade dollar CAD essentially on any kind of technical or fundamental basis, simply because unless you're watching oil on a minute-by-minute basis, it's such a you really, in many ways these days, trading oil as much as you're trading dollar CAD as far as the trade goes, and getting no support from BOC, meaning no weak monetary policy from BOC, really didn't help. The other surprise this week, of course, was the Kiwi. And the Kiwi was surprised not because there was anything wrong with the fundamental data. Data, as a matter of fact, out of New Zealand continues to be quite good. But because there was this ominous announcement that the RBNZ was going to make this week about their view of the future. And this was sort of taken and interpreted by the market as potentially a warning by the RBNZ that they're going to cut rates going forward because they see potential slowdown in the economy as they go forward. This seems questionable to me on so many fronts, simply because the economy in New Zealand just does not justify a rate cut at this point. The housing market in Auckland continues to be very strong. Demand still remains relatively strong. The dairy auctions have not been horrendous. Chinese demand still remains to be very strong. So it would be sort of a preventative move that without much need by the RBNZ, but it's not ours to question why. We will have to watch and monitor. If the RBNZ does communicate that it's willing to cut rates, it's certainly going to push Kiwi a little bit lower. In the meantime, it really got hit on speculation of or anticipation of potential rate cut, and that's made it a relative weakness for the week. This is, if it's false, it really presents a tremendous opportunity for us, and we'll take a look at the charts in just one second, because I think if the RBNZ sort of it makes it a tempest in a teapot if the announcement this week is going to be much less ominous than what the market thought it would be. We're certainly due for a bounce in the Kiwi, at least on a relative basis as well. So looking at the resistance or support levels, Aussie now moves up all the way up to 77. 77 is a very, very big resistance level, multi-week level. So we'll take a look at that very carefully on the charts. Dollar CAD really starts to move down, and the support of 127 comes into view. Still on a longer-term base, I'll show you on the charts. It looks like a buy, but it certainly was a challenge to be long this particular pair this week, as it just got completely decimated to the downside. And then Kiwi was very, very weak, but now comes into very critical 70 support. So it's sort of, if you don't think the RBNZ is going to be horrible this week, the 70 support level has got to be a very attractive level here for fresh longs. Let's take a look at the charts here and just see how everything lines up. So let's start with the Aussie. So Aussie got smacked back. I mean, we ran all the way up to 76.50, got smacked back. This is all risk aversion flows. And by the way, that's actually something that we should very much be aware of, is the risk off flows, the yen to the downside. This was, a lot of the stuff was driven, of course, or helped by the yen to the upside, meaning Aussie yen went up, Kiwi yen went up because as yen went up, the yen crosses got pulled along with it, because of course that created a very, very strong carry trade flows. The fact that we kind of failed here is as much a sign, I think, of all this turbulence on the risk front. And now we have the 75 coming in as the support level. 74 would be the really much stronger support level here. And of course that 77 was we were on target to make 77, but it was a very, very strong resistance point all the way up from April and May, and therefore, of course, I think it's going to be a much tougher nut to crack. Coming back down into 75s still, maintains the uptrend in Aussie. As a matter of fact, the Aussie uptrend, as challenging as it's been because it has these very, very sharp sell-offs, still remains a very, very strong play. And I would think, really, it almost doesn't negate itself until you come down to 73s. That's how hard you have to. That's how wide you have to be in order to sort of play the uptrend in the Aussie. But I do think that certainly 75 here, probably a pretty decent first entry. 74.50 to 74 is going to be a very, very decent support level for the Aussie. And unless we have just horrendous sell-offs, we're talking about 500 points in the Dow type of days, it's unlikely that the Aussie is just going to get sold down hard. But that is a very, very key issue to watch out for. So I think a huge risk-off type of a trade will trump whatever positive flows we've had, because we've really just sort of had a very benign environment in the equity market, with the belief that yield is still the play. But if we have just this kind of huge market reactions, the fear will be that there'll be the natural slowdown in the economy that follows that will force the RBA to cut rates. So this is really all the dynamics that you're going to have to be dealing with. It's not a very clear trade here, and you have to be very, very cognizant of all the dynamics that go on here. There is a danger of buying a falling knife if we have massive risk-off sell-offs here dooming it. So I would say if the Aussie is kind of falling on just correction without the equity markets selling off by 1 or 2% a day, it's probably a pretty decent buy. If you see equity markets really selling off hard, I would not be stepping in front of this trade, because I really want to see the equity market stabilize, since the risk-off flows are going to dominate the trade here much more than anything else as far as flow go. And that's a very, very important point to keep in mind across all the COM dollars, but specifically against the Aussie, which is the poster child, for risk-on, risk-off trades. So here's dollar CAD. We went all the way down to 29s here. 27 still the key support here. The frustrating part is, of course, that the 32s just kind of held a couple times. We'll have to see. The other thing is, of course, risk-off flows can push. If oil goes down to 40, we pop right back up through this level. For now, I still like dollar CAD. I still think it's the fundamentally the weakest of the bunch, and even technically, you're still preserving the series of higher lows here, and therefore potential to the upside. You almost want to just kind of dive in here on the Sunday night open and hold it with a probably a 28 stop. Yeah, I would say maybe. Yeah, I'm looking here to see where it is. I guess the low over here would be 28. Yeah, if you break the 28s, you then invite the potential to test all the way down to 27s. Probably, yeah, a 28 stop, and just dive in and see if the trade here could take you back up towards the 30s as the worries progress on the start of the week. But again, a very, very turbulent market, so you have to just trade small and trade carefully. The Kiwi here is the last trade that I think is sort of very interesting. Yes, risk off flows definitely could push us down, but this 70 is a really strong support. It's 1, 2, 3 potential supports here. So you almost, even if 70 gets broken, in other words, if we kind of just break it down, I still would want to be a buyer here at 70 and a buyer probably down to 60, 69 with a really hardcore stop at 68. Like if I want to buy this trade on a pullback, this is the strongest trade there is, and you got to like the 70 as an initial point of decline. Even if we have risk-off trades, they're going to subside, and this is still the highest yield in the industrialized world, and still has the strongest economy in that sense. And therefore, unless the RBNZ just flat out says we're going to start slashing those rates, at which point, yes, you have to step back. But if it doesn't, if the RBNZ does not telegraph to that they're going to cut rates going forward, it really becomes a screaming buy at around these levels, and so therefore presents an interesting opportunity for us as the week progresses. So for now, again, the trades all seem to be moving to the downside. You can make the bid here, meaning that you can just sort of stand tall and try to buy the declines. But be wary for what reasons you're buying them. If you're buying them because we're just having profit taking, I think that's probably a great idea. But if you're buying them in the midst of a massive equity risk sell-off, that's a dangerous play because then I think we could break a lot of these lows here just on momentum alone. So be wary of the context of how things go here. To the upside, of course, we're looking 73 as the resist here, and in Aussie, back up to 76, 50, 77 was the resist. Those were pretty obvious resists here, and they're going to be hard to overcome given the corrections that we've already started here, and given the huge uptrends that we've had. So still buy the dip trade, but with a very, very keen awareness that if risk markets start to really worry about the global stability in the economy, it may be time to step back, because the sell-off could be much sharper than anybody anticipates. I wish you guys the best of luck, the best of trading. Boris, over and out.